process by which banks create money is so simple that the mind is repelled.
I mean, that's like more the old consortium approach, which I think, to be honest, has failed.
So, Mike, I think it's basically let the best horse win. So, we basically want to have a regime in place that's focused on outcomes, not on processes, and run a fair race and let the best technology win. And if it turns out it's an old legacy system, then the old legacy system wins. But I think we're skeptical that will actually happen if we have a fair race with appropriate regulatory guardrails and regulators that are open to the idea of disruptive technologies in their areas.
William C. Dudley, former Fed New York president and current chair of the Bretton Woods Committee, says they are going to have a fair race to see what technology wins.
On all kinds of things. That is a terrible waste, right? It takes 2 days or 3 days to settle. It takes a full day for you to receive cash. This is unacceptable in today's internet age. And so the problem statement is, how can you make this cheaper, better, faster? Can you bring down that 8% to 3% and eventually to 1%? Can you have instant payments? Can you have instant settlements? What are the technologies that allow you to do that? Distributed ledgers are one way of doing it. Wholesale CBDCs are one way of doing it. Private stablecoins can do that. Or you could choose to link up real-time gross settlement payment systems. You don't need a blockchain for that. Or you can link up instant payment systems. So you keep an open mind on, as Thomas said, technology neutral, but focus on the problems. I think many of us lose our way because we get carried away by the technology and not sufficiently focused on the problem.
To move money, it's slow, costly, and inefficient. It does not sound like the central bankers care how it's done, just as long as it gets done. Ravi Minion from the Monetary Authority of Singapore lists different technologies that could play a role in reducing costs. However, Ripple has a product today that is capable of this task. Also, we hear noise about incumbents monopolizing cross-border payments, but the central bankers are not concerned about keeping this monopoly intact. They're just concerned about lowering costs.
The other big problem we need to solve is trade finance. The cost of trade, cross-border trade, is absurdly high today. All kinds of documentation, duplication, inefficiencies in the system. It takes about 40 sets of documents. There are about 100 different players in the ecosystem for a cross-border trade to take place. In today's inflationary environment, we really could do to reduce those costs. Technology can do that. Digital platforms can do that. And sometimes digital distributed ledger technology can do that. So I think we need to be focused on the technology and experiment with focused on the problem, experiment with different technologies, set clear KPIs, what do you want to achieve, and then see how it goes.
In a world of high inflations, protocols like Zinfin's XDC are reducing the costs for trade finance. Removing the middlemen from trade will lower the costs of trade and thereby reducing the costs for consumers and eventually the CPI inflation rate.
Currencies and all that stuff and the speculation that's going on in that area to the technology and the blockchain and the things that the blockchain potentially can be used for. That's our next brief. Our next brief is going to be on technology, and we're going to start to explore what the technology can do that the existing system can't do very well. I mean, this existing system is very batch oriented, as you know, and I think we could move to something that's really 24 hours, 7 days a week, instantaneous payments, and if you do that, all of a sudden a lot of things go away, like settlement risk. Settlement risk is a huge problem in the current regime. If we could get rid of settlement risk by moving to a different regime, that'd be huge in terms of making the financial system more robust and secure.
Perhaps you can just spell that out.
Sorry, Sheila.
I was going to say, so I don't think that our viewers will be familiar with settlement risk as a concept. So maybe you can just lay on that a little bit and explain that a bit, how that works for our viewers.
So settlement risk, think of settlement risk in the stock market today as I buy the stock, but I don't get possession of the stock for 2 days into the future. So there's this period between where I paid, but I don't actually have the stock in my possession yet. So imagine someone fails in the meantime, that could disrupt the transaction between me and the stock seller. So I think settlement risk is about the fact that there are delays. Another example of settlement risk is a lot of the retail payments where they're using the ACH automated clearinghouse rails to make payments peer-to-peer between individuals. But that actually doesn't settle instantaneously. It settles the next day. And so there's always a risk of something funny happening in that interval that creates exposure and risk. And that exposure and risk then, feeds back in terms of how people behave and manage that risk.
Settlement costs are high because it takes days to actually settle. While you may receive a payment in your mobile app, the funds aren't actually there. It's just an IOU. With XRP, you can settle instantaneously, taking away the settlement risks. And with low risk comes lower cost. Exact settlement costs are not possible with the legacy system, but with digital assets it can be, and eventually I think it will become part of regulations to provide exact settlement costs.
So I think when we kind of looked at the cost of that, we found, it's incredible in terms of post clearing and settlement. So we estimated 133 billion per year being spent on settlement failures, and that percentage actually increases with market volatility. So in the recent, year, as well as kind of during the kind of COVID-led market volatility, those costs have gone up just because volatility has gone up. So, the dollar translation, so even a 2% failure rate has been estimated to result in costs of as high as 3 billion. We are seeing kind of EU regulators come out with new guidelines to actually restrict, kind of come out with settlement discipline regimes that are actually going to lead to more fines if the participants are not adhering to those regulations. And again, it's going to be kind of trying to solve for a problem that there isn't a solution for, where on the one hand market volatility is driving up settlement fails, on the other hand you're getting squeezed a lot more by regulators, and that's why a lot of the kind of capital market participants are turning towards technology, and in particular looking at blockchain technology for potential solutions.
133 billion has been spent on settlement failures. With volatility in the market, the settlement failure is quite common. Regulators are fining institutions for the settlement problems, adding to the cost. You have probably heard Garlinghouse speak about 3-second exposure in a digital asset market. A highly volatile environment is actually less risk than a SWIFT transfer that has a long duration in fiat or forex market. With these costs increasing, more institutions will look to technology to offer cheaper solutions.
Price collapse and bankruptcies across many crypto firms. And this is not necessarily bad, and I say this as a regulator and a central bank. It's a great opportunity to separate the wheat from the chaff. I think there has been a bit too much speculative frenzy. And if you think about what the blockchain, what the asset tokenization, smart contracts can do by creating economic value, enhancing financial inclusion, transforming business processes, making lending, payments, and so on easier and faster. I think many in the industry, if I may say so, have missed the plot, because the crypto tokens that are powering these blockchains have taken a life of their own, and speculation in cryptocurrencies has, I think, brought great damage. The lives of investors who've lost their money is one, but the waste of resources is another. So I think we have a great opportunity here in this conference to reset the path towards actual business transformation. And just to give by way of example, that's one of the things that the MAS is trying to do, even as we take an increasingly tougher stance against retail investments in cryptocurrencies, which we think is a terrible idea. It's important to promote the technology, the industry, and use cases, be it in asset tokenization, decentralized finance, and so on. So we just launched last week what we call Project Guardian, which is a way to apply asset tokenization to financial assets, and to see, by creating a pool of tokenized deposits and loans, we can generate greater economic value at lower cost, at lower risk. I think we need to step up these kinds of innovations and experiments so that we can make breakthroughs in applying this, I think, this technology, which has fairly good potential.
They want to separate the wheat from the chaff. The crypto with utility will persevere. Reset the path with regulations. He mentioned Project Guardian, which is going to tokenize real-world assets and have a shared liquidity pool. Like you said, they're trying to reset the path back to utility.
Well, I think the issue here is basically to identify the positive use cases, because if there aren't positive use cases, then what are we actually going to use this stuff for? So the idea is that the current financial system has a lot of difficulties. So think about the total amount of spending that's undertaken on finance as a share of GDP. It's actually much higher than it was back in 1950. So the financial system is becoming more complex. It's probably becoming more inefficient. And as a consequence of that, there is actually quite a bit of room for a new technology to come in that's not legacy-based, that's not batch-oriented, to reorganize how we do things. And to enable things to be done in a much more efficient way. Cross-border payments is a great example. I mean, right now that's really expensive. You take the migrant workers who are sending money back to their families. There's 6 or 7% of the cost of the transfer just gets eaten up by foreign exchange fees and other payments. There's got to be a better way of doing this. And so once we've identified the positive use cases in this brief, the next brief is going to turn to technology and basically explain how this technology can do things that the old technology cannot do things. And then that creates a sort of a basis for why we should encourage this, why we should foster this, and allow it to develop.
The Bretton Woods Committee is using the example of cross-border payments as an example of why this technology should be fostered. He talks about leapfrogging the system entirely with this tech.
I think we can all agree that irrational speculation in any asset class, especially in an inefficient market, is a terrible thing, and the retail speculator will be left holding the bag. But the proposition I have for the panel is that, would you agree that the utility of any asset is built on liquidity, and that liquidity is backed by speculation? And if you agree with that proposition, what's the path to create efficient markets in crypto that would allow for responsible speculation to build utility for things like cross-border payments and cross-border trade?
Great question. Thank you so much for
This was Stu Alderati, the General Counsel at Ripple.
that. Let's go down the line. Let's start with you, Thomas, and your response.
I'm not sure whether I really have a good answer to this question. So the question, or in my view, whether we need those non-central bank crypto assets for those kind of activities, or whether we need only stable coins that have some link, some regulated link to central bank money. So in my view, so far, it's mainly a speculative asset, these kind of crypto assets, and whether the true contribution to a functioning or the use case in financial market, this is something else. So I'll leave that open. I believe what we really need is that we have, for those tokenized assets, or those who are then have a function of money, we should have enough liquidity, and we should have exactly the regulation that everybody knows what it means and what the promise is, and for what purpose we can use it exactly. Thanks.
Thomas, thank you very much for that. Ravi?
I would be wary of equating the utility or efficiency of an asset to its liquidity. Dutch tulips had great liquidity in its heyday. I think what's more important for any asset, financial or real, is what is the underlying income stream or revenue stream? What is the real economic return over a period of time? That is what defines the value of an asset. Now, of course, we differ in our opinions, and that's why there is trading and there is liquidity if there are enough buyers and sellers. So on that point, my question would be, many of the crypto assets, not all, but many, a good number of them that are today being traded enjoy high liquidity. I'm not sure they're backed by real economic value. Is there an underlying revenue stream? I think that's the key question we should all be focused on, that in promoting liquidity and markets in crypto assets, we need understanding of what are the underlying economic streams, full disclosure of those things, which is how securities markets function.
Yeah.
And those are efficient markets. Not every security is worth, but at least there is a market that is based on disclosure, that is based on regulation, and that has liquidity so that people can exit and make their choices We need the same in crypto world. And so let's not confuse active trading and liquidity for what is the real thing. Thank you.
Thanks, Ravi. And I think, Augustine, that goes back to what you were suggesting earlier.
Absolutely. And just to say, we need to put the horse in front of the carrier. And what Ravi said is just that. If you have a good asset, you have good information, you have all the elements that is needed to have a healthy market, liquidity, volume will result, you know. When you don't have those basic attributes as Ravi defined, you will not get that, you know. So you might have an asset right now that can have a lot of liquidity, but if it's ephemeral, then it just doesn't work. And then is when you have to face the music.
There we go. We come back.
These central bankers create these massive bubbles by printing up money, and then they have the nerve to say that liquidity doesn't matter if there is no economic utility. Basically, what all three of them are getting at is there needs to be CBDCs and real-world assets like stocks, real estates, and commodities, and those will be sources of liquidity in this tokenized world. Stu Alderati could have posed the question differently, and Augustine Karsten says you're putting the horse before the cart because he knew Stu Alderati was talking about XRP, and XRP is a liquidity tool that balances liquidity. So the garbage needs to get washed out of crypto, and the real-world assets with regulations need to come in. The capacity for erroneous belief is very great, especially when it coincides with convenience. Thanks everyone, I hope you enjoyed the show. Please take a moment to like and subscribe. If you enjoy work like this and wish to support my channel, please consider joining my Patreon.